Everyone has dreams of retirement, many of which involve things that cost money. Whether it's maybe special vacations with the family, gifts to kids, charitable organizations, house renovations, or simply the freedom to say yes without running a detailed analysis or calculation first. The list can continue and go on. But how you actually structure your savings going into retirement will determine how much flexibility you have to spend on those things, and really on genuine emergencies as well, especially as it relates to how each source of money affects your taxes once you actually stop working. Here's the simple framework. Among the families I sit down with, a large portion have done a great majority of the retirement saving in one type of account: traditional pre-tax accounts, like a 401k or a traditional IRA. Every dollar that went in got a tax deduction, but every dollar that comes out in retirement is actually taxed as ordinary income. That's a powerful tool in your working years because it actually reduces your taxable income while you're earning the most. But in retirement, however, it creates a situation where every withdrawal generates a tax bill. And there is a mechanism called required minimum distributions. It actually forces you to take money out on a schedule set by the IRS, not you, whether you need it or not. It's pre-tax money, which is not good or bad, but it does mean that if you ever want to draw additional income for something fun or an emergency or possibly a larger tax bill that's come your way, you have to back into the amount knowing the tax impact that will be owed. The counterpart is after-tax money. Roth IRAs, Roth 401ks, these were actually funded with after-tax dollars. And so qualified withdrawals, including all of the growth, come out completely free of federal income tax. No ordinary income added to your return. No capital gains. Nothing that pushes you into a higher Medicare premium bracket or possibly increases the taxable portion of your Social Security benefit. The flexibility this creates in retirement is significant because a meaningful Roth balance gives you a source of spending money that does not trigger a tax consequence when you actually use it. A third source is a taxable brokerage account. These hold money that have already been taxed, and withdrawals are generally subject only to capital gain rates rather than ordinary income rates, which are typically lower. You also have control over when you recognize gains, which gives you another tool for managing your tax picture year by year. The practical point is this: if you enter retirement with all of your savings in pre-tax accounts, every financial decision, a vacation, a home repair, a gift, an unexpected expense, triggers a tax bill in ordinary income. You almost have zero flexibility when it comes to the tax strategy on the structure of these accounts. And it does really limit your options, possibly when you desire or want to take those funds out of those pre-tax accounts. With Roth, taxable money, brokerage accounts, you do have some flexibility and some choice of where to draw from at different points in time. That is what tax diversification means in practice. And it matters most for retired folks or possibly folks that are anticipating retiring in the next few years and how they build their income in retirement. The goal going into retirement is not just to have accumulated enough. It is to have that money in the right places. If the large majority of what you've saved is in pre-tax accounts, there's often a window before retirement or even soon after you retire, particularly before Social Security starts and RMD start, where you may be able to convert some of that money into a tax-free account, such as through a Roth conversion. When to do that and how much to move in a given year are planning conversations that really do belong on your agenda well ahead of your last day of work. This is a topic I help families answer for themselves on the runway towards their retirement. If you want to learn what you should be doing over the last few working years of your career, please schedule some time with me. We'll put a plan together just for you.